All right, let's go live. I'll give it a couple extra minutes to allow people to show up. Bonjour. Hello, Sandra. I hope everybody can hear me. Let me know if the sound's okay. I can boost the mic a little bit as well if it's good. I see Martin's in here. Hey, by the way, I'm sporting my, well, you can't see it, I guess. This way. Canada. Maybe it's backwards for you guys because it's mirror image. Got my tea going for, you're good. Okay, good. Sounds good. So I'm a little stuffed up. If you have kids, you know they get sick often. So I caught it from him with running around. So anyway, we'll try to do a good webinar, answer all these different questions. Make sure you go ahead and ask a question. If you don't have one that you've put in, go ahead and put it in this area, in this box, ask a question, suggestion, so we can go through some of these. And if there's ones that you prefer to get answered, you can go ahead and upvote it as well. So we'll give it 1 or 2 extra minutes here because I know I said I'll start at 9:05. Usually I give it a couple extra minutes for people to try and show up. But go ahead and place your questions in there and make them detailed, and we'll try to knock out some things today to give you as much detail in my time for the market, for any questions that you may have if you're just starting out and anything like that. So I hope everybody's doing well. Had a interesting week here with the markets, the earnings here that have been coming out with Apple and all the other stocks, that tech-based, Amazon shooting up like a rocket. So a lot of these companies have been moving very sky high, but the VIX, of course, as you know, has not been doing too well. It's been going low, and for active traders, I always say you want a higher VIX, which typically means a sell-off. And that's just because you get more volatility. With more volatility, you get more opportunity. With more opportunity, it allows you to make more money in the end. So in either case, with the volatility as low as it's been, it does concern me to some degree. And, it's something to always be careful of. When other people are greedy, you probably want to be fearful. And when other people are fearful, you probably want to be greedy. So in other words, buying stocks when they sell off and selling them as they continue to go higher. If you look at the SPX, you can see we keep treading and grinding higher. Those of you that are my bears, I'm sorry. It's just what's going on, what's happening. There's been a lot of volume that also came in with some of these tech stocks. We are stretched. I would still like some pullbacks, even if they're light ones. But this is just the market that we have going on. So anyways, and without a pullback or a good solid pullback in quite a long time, you definitely want to be very careful because it just means it's stretched like a rubber band. And, it can go on for months, years. You never know, but you always want to prepare for the risks at hand. And that's what you need to do as a trader. So in either case, let's see here. I think we're pretty much ready to start. Okay, who else do we have? Hey, from India. Okay, wow, wonderful. What time is it in India right now? It's probably around, 9 a.m., depending on what part of India you're at. First webinar. Well, welcome. Thank you for joining us. Be sure to post your questions if you have any. I'm going to try to get through them. 7:30. Good for you for waking up. Okay. Early bird gets the worm, I guess, as they say. I think the last couple weeks I've been waking up around 5:30, so 5:30 or 6, and then some nights or some mornings 4:30. So I guess everybody has their schedule and routine. So I'm exhausted by the time we hit 8 o'clock, 9 o'clock. I'm worn out, especially with the long days. How to select candidates for selling cash secured puts. Okay, good question. A lot of good questions in here. Time zone am I in? I'm on the Eastern time zone. So it is 9 o'clock here, 9:04. So I'm on the East Coast. I've always lived on the East Coast here in the States. As far as living in Russia, well, that's 12 hours forward. So it would be 9 a.m. there. I was in Siberia. Bad lag. Okay, I'm sorry. It is a webinar, so it's live. It'll be recorded and it'll be posted. Sunny Florida. Yeah, Florida's great. They also say it's heaven's waiting place, but I do enjoy my time there. Okay. All right, so let's get started. I do want to welcome everybody to the webinar here for another Let's Talk Stocks episode. We have quite a handful of good questions. I'll try to cover all of them in as much detail as possible. If you have any specific questions, please go ahead and put them in the question section now or soon, rather than waiting till the last minute. That way we don't wrap up and just have a whole bunch of questions coming in at the end. So a quick overview on the markets. As I've mentioned earlier on the introduction here, we do have the markets continuing to grind higher. Every step of the way continues to move forward. If you look at the SPY, we grind. And a lot of this is to the tech when you look at things like Amazon, Facebook, although there's some weakness here overhead on Facebook. Even with Amazon, they're a little stretched for my taste. I don't like prices this high. I'd prefer pullbacks. Now, we did get a slight little pullback with Amazon here, as you can see. Even things with like Microsoft, you know, this one-day pullback is not really a huge pullback, but we do have this little gap right here that has happened. So again, it concerns me when a stock like Microsoft, you know, goes up on the weekly or the monthly so high. You take that angle of elevation from a certain angle and you rotate it, that becomes a little bit dangerous. So in either case, watch out for these kinds of things. Even things like Tesla are moving pretty quickly, but this one's selling off to the other side compared to some of the tech companies. So you can see here's a key support level that you're watching on Tesla right there. Another one, of course, is Google, big one to watch. Also gapped up. If you were able to short it right there on the gap, shorting the gap, fading the gap, they call it. You're able to do kind of a day trade or 2-day trade here. And then, of course, these things will usually run. Sometimes I've often seen these come back into it within the gap. But in this case, this market likes to grind higher. So be very careful. It's a grinding market, but it also increases your risk to that downside. So that's kind of my concern, is that when you don't have the pullbacks, the risk increases because the pullback, when it does come, usually becomes larger and you get some nasty movements. So, you know, it's always nice to have a pullback. I'm always a bear in my mind, because when you're bearish, you increase volatility. With increased volatility creates more opportunity, creates higher option prices, creates better movements in prices rather than this 3-point, 5-point movement. That's very minor. Instead, when you're bearish, you have a 20, 40 point down flush, and then you have a pop 40, 50 points. Usually takes 3 to 4 days if the 40-point down move took 1 day. So in either case, I'm always bearish because it creates opportunity. But in either case, with you as you're watching these stocks, be careful in this environment, because the grind higher, and then all of a sudden you can get a flush where it just takes you out. So trade either lighter, protect your positions, and just be very careful what you're doing, especially if you're new to the market, because this is one of those where a lot of new traders get into bullish market conditions because everybody else is getting in. And then what happens is all of a sudden, well, the bullish market turns bearish, or digestion period, and a lot of new traders lose out. And that's where a lot of traders become gone. So let's take a look at some of these questions. Let's knock them out little by little and go through them. I think I saw, let's see if there's any upvoted. Okay, so first off, let's start out with some Canadian folks. Let's start answering this one. Canadian marijuana stocks are blowing up. Do you think there is any risk involved? Linda asks this question. Of course, there's risks with marijuana stocks, with anything. There's always risks involved. The question comes down to, what risks are you thinking of? What risks can you handle? What risks are you willing to take to be able to gain for the return? I don't look at any industry specific. It could be marijuana stocks, it could be airline stocks, it could be an underwear company. You look at Under Armour, for example, that used to look at this one, it was a high flyer when the IPO came out, and then, well, with time, wasn't as hot anymore. So things happen, right? So it doesn't matter really what the company is. What matters is what are people investing in and how is the perception relative to the price? Because the price is always perception, right? It's what does it really mean when a stock's at $10? It's a matter of what people are willing to pay for that. So marijuana stocks, could you invest in them? Yeah, it depends on the ticker symbol. Do I know what they're going to do? No, I look at it at the time and evaluate it based on what I see on the movement. So that's kind of what I do. And it's not necessarily, if they're blowing up, if they're too far stretched, you want to be careful, of course, because then they get a pullback. So that's really the main concern for me, depending on what you're looking at. But are there any risks involved? Of course, there's always going to be risks involved with anything in trading or walking down the street. There's always going to be some kind of risk there. It's just a question of which risks are you familiar with and which ones you can handle. Okay, so let's go to another Canadian. Here's Martin. Let's go to this question. It's a great question. I love questions, anything that is related to psychology. So, hey, Sasha, I know it can be personal to each trader, but before being profitable, what behavior do you recommend to have with our family who doesn't have an idea of the market and what the learning curve is? Should we lie and say everything is good, tell the truth about the losses and receive and complain and bad energy from them, or avoid talking to them about trading? The reality is the emotions, the good ones and the bad ones, are impossible to hide to those who we live with. It's definitely very difficult to talk to people, especially your close involved family members who don't understand trading and can't grasp the concept of it. It's a whole different world because they don't comprehend the risks involved. They don't comprehend what you see, and it's a whole different industry. So would I lie to them? No, there's no point in lying to family members. This kind of creates tension. It's kind of like loaning money to family and friends. You don't usually want to do that because it can create tension. It's kind of like getting into a business dealing again with your family members. Sometimes you just want to avoid it because there's tension that will occur. There's no reason to really lie to them, though, as far as what you're doing. The thing is do you need to share everything with them? No, you don't. And for example, even with my folks and parents and, just close family and friends, I don't really share with them, my stresses that are involved with trading, because I still do have them. Sometimes I do, but it's very rare that happens. And, and I might share a subtle thing. Maybe, work's busy. There's a lot of things going on. Things aren't working out in my favor. In those situations, it's good to always trade lighter, especially if you haven't grasped things. But it's tough to manage those emotions and put it on people. I know we want to chat with people and get those things out. The better approach would be to gather and have a friend that you can connect with and network with. And if you have a friend or colleague that you just coordinate once a week or once a month together and just chat about your strategy, chat about what happened throughout the week on the stock market. So if you're, let's say, in Canada and someone else is in Germany and you're traders and maybe you've never met and someone connected you, it's a real good way to just coordinate things and just let your emotions go. And that's one of the better approaches rather than spilling your guts to your family. Even when it comes to work with your family, sometimes they just don't understand the situations that is involved there. Just because you're in a whole different world. So again, I would say trade lighter or smaller at the beginning till you get things, which reduces the stress. There's no reason to really lie about it. Just you may not need to share every single detail of what you did, how much you lost, how much you made, all those kinds of things, because it does start to kind of add up and take a bit of a toll on you emotionally, but also on your friends and family. I hope that makes sense. You know, of course, with, you know, your very close ones, your wife or partner and so on, you probably will need to share some details. So that, of course, is going to be an important part of the relationship. Okay, so let's take a look at another one here. Okay, so here's another good one. What is the difference between a pullback and a consolidation? Did they give the same results, or do they give the same results? Pullback is usually a retracement. So a retracement could be to the upside when a stock is moving down. Like, let's take this stock, for example. When a stock is moving down, you could say this slightly is a retracement. It's probably more of a consolidation. Usually retracements or pullbacks are at an angle. So whether it's this way or this way, depending on the direction of the stock, they're at an angle, whereas consolidations are more sideways. Do they give the same results? Yeah, they do. They give breathing rooms. They give a chance for the stock to digest the upward motion or movements. When, I believe, is a very good one to explain this. So if we look at this movement here to the upside, here is our pullback that we have right here. And you can see it gives that stock breathing room to continue moving higher. Okay. Whereas here, which is a little smaller, I'll zoom into it here in a second. This, I would say, is more of a consolidation or a digestion. Again, it allows you, a consolidation allows you to digest moves. Also, another one right here. Now, if you go into a shorter time frame, you can see these even more so. So again, so here we have a little bit of a consolidation right here. And here's some consolidation. This one is longer, as you can tell, than the previous ones. And this is where the stock changed direction quite a bit. So you could see the longer digestion moves, right? If this was maybe steeper, or we had kind of, let's just say, something a little bit different. Let's say we've had maybe a further pullback that was stronger, a bounce, pullback, and then started going in this way. You might have had or needed less time. But in either case, the point of a pullback or a consolidation is really to digest that move. That's really the whole point. And the longer or the stronger the move, either to the upside and then you need a pullback, the stronger you'll want that pullback, or the longer in time you'll need it. It's like going to a restaurant and you go and eat a whole bunch of food. You know, the same concept applies. So if you just have one plate full, well, you don't need as much time to digest. If you try and have 5 or 7 plates, you're going to need a lot more time to digest. So the same thing in a stock. When you have a massive movement, you know, you need time to digest and turn around that boat. Now, even though you had some here in between, some digestions, that digested the small lower movements, right? So they all take time, and that's kind of what you're looking for. If you take a look at Apple, the same thing here. You know, I mean, massive movement, digestion, or pullback, really, but it digests the move. Again, pullback, it digests the move. You can see there's no sideways consolidation. Tesla's a real good one for the sideways consolidation to teach this. So you could see here, this was consolidation or digestion, and then you had your move higher, then you had your pullback, then you had a nice consolidation, digestion for the next move higher. So there you go. If you're looking at ABCD patterns, you could say here's A to B, B to C, C to D. And if you're looking at the bigger perspective, you could say, okay, A to B, B to C, C to D, right there on a larger scale. It's just some thoughts and ideas. It took me a while to get the ABCD pattern, really. Okay, let's go to the ABCD pattern. I saw a question here on the ABCD pattern. Okay, I'm interested in two things. Where can I find information on your ABCD process? And number two, I have Think or Swim and need to learn how to use stops. Can you share and give some direction, please? Okay, absolutely, Mike. Excuse me. All right, so let's take a look at some ABCD patterns here. All right, so looking at ABCD patterns, they take time to really understand. Usually they're a little bit easier to find on things like the weekly if you're new. It's also, they're more concrete, more precise, and more reliable. So that's why I prefer to look at them on the weekly or the monthly, especially if you're just getting started. Do they happen on the daily? Absolutely. But they're a little more difficult to spot, but you could still see them. For example, looking at it here, you could look at it actually right here, and then again you could continue this pattern, but there's more noise there. As far as the process goes, it's tough to explain it here. I could probably speak an hour about ABCD patterns. Usually they come with swing points, so when you're looking for stock movements and swing points where stocks change direction, this is where you can find potential ABCD patterns. It doesn't always work out, but it gives you a starting point for learning things. You know, sometimes they're hidden. With Tesla here, I actually had a nice short that I remember a while back. I looked at it like right here. This was my ABCD pattern that I watched in Tesla. It's a little nasty looking, but it worked out really well for me on the trade right here. Simply because this, I noticed this was the retracement. And the reason I could tell this was that lighter volume right there. That was the key for me. And when I saw this volume pick up again, that was the shorting opportunity, and that was a good trade, and I remember it. And one of the other key takeaways, of course, was this big bar right there. So that's kind of a big flag. And then once the stock goes higher here with a dry up in volume right there, showed me that it was an ABCD pattern. Did I know it would go here to this point and stop and continue moving forward? No, I didn't. But what happened here, as you can see, it was the next leg, the volume again dried out. So that again, as it started to pick up right here, told me to get back into the trade. Anyway, long story short, when you go to Apple, it's another one to, there we go. It's another one to look at ABCD patterns and study them. It has a handful of them. Again, swing points, swing points, swing points, swing points. When you take a look at this from swing point to swing point right here, you get about 90 points. The retracement, if you do Fibonacci sequence, Fibonacci is not always reliable. It's a guide. It's a guide, right? But you can see how that guide comes right into that 50%. Okay, so again, we had from here to here, 88 points, and then from here to here, 81, 75, 79 points. So fairly close and worked out well. Now we're getting the next leg, right? So here we have about 75 points, and then next one, we're already 88, so we're a little stretched, and that's why I say we're a little stretched here. So I hope that makes sense. As far as stops go, I mean, if you're talking about mental stops, then that's, you know, personally, depending on where you do it, I do it usually a little below certain swing points. Could be on the daily as well. So if you have, let's say, a swing point like over here, I would put that stop, you know, $1 or $2 below that, because stocks wiggle around a little bit. So you have to give it a little room. They don't hit those lines perfectly. The stop should be more of a range rather than a line, right? So anytime I draw a line, it's usually more of a range. Okay, so if you look at stops, just some playing trades here that I put on sometimes for teaching purposes. But in either case, if you look at stops with a Thinkorswim platform, you know, it depends what you're doing, but you could go ahead. There's just You can create a closing order, and then there's just different order types, and that really just comes down to personal preference, what you're doing. So for example, I don't use any of these. I just place my order in manually, but there's like trailing stops that you could do, and you can do even a percentage basis. I have it a little zoomed in, so it's harder to see the actual numbers here just for training purposes. So you can't really see the exact numbers in here, but you can see there's a few different order types, and they even put in this MOC and LOC recently as well, which I'm not familiar with, but you can go ahead and give them a call and they'll be happy to walk you through some of those stops and information. Okay, let's look at some other questions here. Let's see if we got any other questions. Options. Do you always own the stock or only when you place a naked strategy? I'm not sure. Is there a question when I trade small quantity? How to select? Okay, so there's a couple of options related questions. Let's do a few of these option related questions. Okay, what's in option? Let's start with this one. In options, do you always own the stock or only when you place a naked strategy? When you trade options, you don't need to own the stock at all. It really comes down to your option level and approval and requirements that you have within your broker, but you don't need to trade. You don't need to trade the stock at all. You could just trade the option, and that's what many beginners kind of don't understand when it comes to options. You don't need to own the stock at all. Now here in this example, let's just say we take. Let's say we take Netflix. That's a nice even share amount. Netflix, 100 shares here. What you could do is, since I do have the stock here, I could sell a single, analyze the trade. So now what I can do is, since I'm long 100 shares, right? This one's at profits, $6,683. I could go ahead and cap this one by selling the 215 call, and it allows me to make, let's just take this off, put this on. It allows me to make $151 extra if that stock stays under 215 within, 36 days, 37 days. So within 37 days, if it stays under that 215 range. So it's another way to make a little bit of extra money, but I could actually just sell this on its own. I don't need the stock, but you need to be approved for that in an account for higher option trading requirements. Of course, you could also do things like, let's do a calendar here to show you an example. Buy one on the January 18th shows you a little more advanced option trading strategy. This, of course, without any stock, and you can see what happens day in and day out. That white line is the current today line, gets closer and closer to that green line. And eventually, with time, I could get out of this anytime, really. That option premium decays because the one in December decays faster, the one I'm selling, than the one in January. Now, keep in mind, this is a positive vega, so as volatility increases, this graph also grows. So as you look at it, it starts to expand. Again, a little more advanced for the question, but it gives you an idea. Hope that makes sense. You don't need the stock, though. And as we get into the next question with this, Nick asks, hey Sasha, I've been approved by my broker for option trading at level 1, which allows for covered calls and long protective puts, since my account is an inherited IRA. It looks like that's the only level my broker will ever approve. Does this greatly limit my potential investing power in option trading? I mean, is it more serious money-making capability, more so at the higher approval levels, or is level 1 approval really all I need to be very competitive in option trading? Yeah, it's an interesting question. With IRA accounts, they will limit you, and you don't usually get the higher permission levels when it comes to trading options. For example, like naked strategies, level 4 option trading strategies. You can't even get portfolio margining when it comes to IRA accounts. And if you've never heard of portfolio margin, let me share with you what that is. You know, think of it like going into a bank, right, and taking out a loan. Most people know about margin. Most people do not know about portfolio margin. So when you go into portfolio margin right here and you start looking at it, how does it work? Well, in portfolio margin right here, they take a smaller amount. So instead of, let's say, you going on and putting in $50,000 on a stock or a trade, they only margin you out a certain percentage. So instead of $50,000 on a trade, they might give it to you for $20,000. So it allows you to trade almost 3 times as much. So instead of going to a bank, taking out a loan like you would to buy a house, this is the same thing, except you don't have to pay anything extra for it. The only way to get that is if you take a test. You have to take a test, which I took that test. It's not too bad. You get approved. You also need to have at least $125,000 in your account. There's a lot of other requirements that go with it. But can you make more with higher level of options? Absolutely. You definitely can. We live in a capitalistic world. So the more money that you have, the more you can make. And that's the sad part about it, because for me, I also always advocate that. And one of the things I always say, when you go to a bank and you want to open a safety deposit box and you just got your first job and you have $100, well, that safety deposit box is going to cost you $50 a year or $100 a year. It's not set up to help the poor. The economy that we have is not set up to help other people. It's set up to make money. This world, as far as economically goes, is set up for people with money. And that's kind of, heartbreaking when you think about it this way, because you have a guy that just got a job. He wants to open up a safety deposit box or even a bank, and you got monthly fees of $20 when he only has $100. But you put $5 million in there, you betcha you're going to get free checking. You're going to get a free safety deposit box, and you might even get a free massage with it. They'll do a lot of things for you at those banks the more money that you have. And that's just the way the world works. It's sad, but that's the way things work. Now, fortunately, people naturally, I would think, are good people. That's just the way I look at things. You look at a lot of charity things that go on with people like Bill Gates, Mark Zuckerberg. They contribute quite a bit charitably, financially. And that's kind of the human factor that's great around just people. But unfortunately, the business side of things and the market is it's based on greed. So the same thing with option trading. When you look at option trading, especially when you're in an IRA right here with this question, yeah, you're going to make less money when you can only sell covered calls, because you have to hedge, you have to do protection. Because when you have a stock right here, what you could do, and I'll show you some of the strategies that I basically can do. You could just go ahead and sell this as a single, and I could go ahead and let's take this off. I could go ahead and let's fix the volatility, and let's fix the time for today. So I could collect $72 on this trade from selling this naked, right? Selling it as a naked strategy at the 170 for Netflix, right? Netflix right now is almost at 200. With a level 1 or let's say level 2 option trading where you could sell verticals, you still need to buy a single to protect that. So now you're buying 40 cents to protect it. So that 72 that you're making initially, you have to take 40 for the protection. And now you only make $32. So why do you think banks like Wells Fargo can leverage the heck out of themselves? And then when things go sour, well, they say, it's not our fault. Well, this is what happens. They do this leverage right here, things like this. Companies do high risk, high leverage things, and they make a lot more money because they don't need to hedge and protect. That's why, I always like rules and regulations for, big companies and corporations. I like to slow those things down because they have a lot of capital. But you look at this, the amount of money the little guy can make, well, he's only going to make $32. big companies and corporations, hedge funds, they'll make the 72. They don't need to have level 1 or 2. You know, they go level 4, and with portfolio margining, and they take loans out to do these kinds of things. This is what happens. That's the industry standard. So yeah, you do limit your potential as far as making money. So level 1, always good to have higher level. Hope that helps. A little bit more detailed, I guess, than I should have went into. And then let's get into right here. I have a question about closing sold iron condors and taking profits early. Sometimes I can't buy back the condor I sold and close or reduce my position size. It's not being able to get out of position on a typical thing. Can you explain any complications that might arise when buying back iron condors? Thinkorswim is my platform. Thanks. Do you have a ticker symbol that you're watching or trading this or having trouble closing? Let's take a look at that if you can type it in. Excuse me. Shop. Okay, shop. Let's take a look at shop. I don't think you should have a problem, but let's look at the liquidity. What you really want to look at is the liquidity of the options and the volume, right? So when you look at the option open interest right there, and that's kind of the main thing, is the option open interest. The question also comes down to is which strikes and dates are you trading? That would be my next question for you. Which ones are you trying to close out? What area? How far percentage-wise? December. Okay, and what strike price? I mean, if you're looking at December 17th, right here, the standard options, not the weeklies, right? If you're doing the weeklies, there's usually less open interest. So those are a little tougher to close out. You have to pay a little more of a premium, and you take a little bit of a hit on that because the liquidity is less. I find I struggle a lot with companies like this, like Priceline, just because the open interest is very limited. You can see it doesn't trade that much. So even when you go to the standard options, the open interest is light, at least for me. You know, and when you look at shop right here, and you're trying to trade options, if you're doing the weeklies, yeah, you're gonna maybe have some trouble. So you have to take a hit, which means the bid-ask spread is not gonna be in your favor. So you have to kind of give a little. If you're doing the standard options, you should be okay unless you're trading like 90 contracts, which I doubt you are. 5 contracts, but at what strike price? Is the question, is what strike price are you trading? So 5 contracts, you know, you shouldn't have a problem with 5 contracts, especially if you're kind of in this range, 80, 85, 90, or even 110, 105, 115. I don't think you should have a problem. If you're in the weeklies on this December 8th, here's December 15th, because you said December 17th, so there's, forgot my strikes. Okay, so I'm going to say the only thing you should really watch out for is if you're way out on your strikes and the open interest is light, then yeah, you might have some trouble and you need to give a little bit to get fulfilled or get filled on those orders. Otherwise, you shouldn't have trouble. The other thing you could do is get out of it in verticals, because if you do it in vertical, sometimes it's less for the market makers to fill all in iron condor, especially if it's kind of moving against you or in a weird position. So sometimes doing a vertical on one side, then doing another vertical on the other side, taking it off in legs can be just fine, and you can put those in real quick together. But that, of course, depends on if your capital allows you to. So anyway, you shouldn't really have a problem though on that unless you're trading lighter. Okay, let's see. Okay, let's take a look. How do you get approved level 4 for selling calls naked? Is it experience, money, or how long you've been with your broker? Yeah, everything. I mean, they take a look at everything. Experience, how long you've had that open account. They might even look at your track history. They might make you take a test. Really just depends. I got approved a while back, and it's wonderful. You can make more money on it. But yeah, you want to call in and ask them, but they're not going to give it to you right away because they take on more risk. because what happens is, I mean, imagine I go ahead and sell. Actually, let's do it this way, because I sell a lot of calls, actually, simply because I'm trying to hedge my other side positions. You know, you got this risk on, and let's say if I'm selling, you know, let's do 10 of these, and look at the risk you could have on here with just 10 contracts. You're looking at 211,000 on the loss. Now, yeah, that's at $320 a share. But even if it gets to 130, you're at $22,000 loss just if that stock jumps to 130. So, you know, the losses can become extreme. And as you start trading larger, yeah, they get intense. And the broker, if you don't have a lot of capital in there and you haven't been trading for a while, they're not going to give it to you, because then you owe them money and they're not going to go chase after you. So they check everything. Okay, any other option related things? Okay, let's go back to the top and let's try and get things going. I've not traded for many years. The last time I did, it was all done through the broker. Is there a class or book I can study on how to put in trades on the different platforms available today? Thank you. I do have a couple of things actually on my website on how to place a trade, I believe, on something very simple. If you go to the Start Here section, there's a lot of things out here. What is a stock? How you make money in the market. So I think this one puts in a trade in there. And there might be some others in here. Step-by-step of placing a trade right there. A video number 19 at the moment. You could go ahead and look at that. So I'm just constantly evolving this section. There's some books you should read right here. There's a full book list, practicing technical analysis, some video courses, and some brokers and things like that. So anyway, so I'd definitely take a look at that. So that's a good section to check out. Also, your broker can help you out with that. They'll usually be helpful to show you how to place a trade because they want you to trade. All right, let's look at this one. Hi, Sasha. Thank you for this opportunity. I'm interested in swing trading, which charts and timeframes to follow for entry and exits once the trend has been determined. Also, how many stocks to swing trade in a portfolio of, say, 30,000 to generate 1% to 2% return monthly. It's not the number of stocks that will determine your return. It's obviously either appreciation or dividends or selling call contracts or trading options that'll give you that return. And it comes down to your risk levels. How many stocks? I always say if you're trading, $5, $10, $20 million account, you don't need more than 5. The only time you're trading more than 5 to 6 positions is if you're more of a hedge fund and you have like 3 people working for you managing those positions. And in that case, you might bump that up, and usually that's with a much higher account value. So usually for most people, 2-3 positions is all you really need, 1 to 2 even. You don't need to be that diversified at the beginning unless you're really worried about things collapsing, or you're a buy and hold and set it and forget it kind of person. The reason I say that is because diversification now is very easy. You could just buy like an ETF and it makes it very easy for you to diversify. As far as the time frames go for entries and exits, I always start with, typically the weekly is my nice go-to time frame because it allows me to spot opportunities faster. Sometimes when I scan 2 to 3 days is nice because it allows more things on the chart, just a time view and time frame. But the weekly is kind of my main thing. I'll also check the monthly to see the bigger picture. So again, monthly, weekly, and then the daily. If they all line up and everything's pointing in the same direction, then it's great. It confirms your chance of success. It makes it much higher. If you only have, let's say, if the weekly is good, the monthly is good, but the daily is bad, well, look at it this way. What does that chart tell you? Well, that means at the moment, when the daily kind of looks like this, it's probably not as favorable to trade that for a couple of days. But again, if the weekly and monthly was good, and for the longer term, it might be okay. So anyways, that's the way I look at it. If you want to optimize it, you're trying to get all 3 time frames. If you only see the daily, sometimes people get faked out with this, like Under Armour that we showed earlier. If you look at this one, right? Which we know, if we look at the monthly, it's toast. If we look at the weekly, it's toast. But if you look at the daily, and let's just say we were looking at things kind of like that, you could say, okay, well, the volume is picking up, stock's going higher, it's getting into the gap, it'll probably get to 25. Shouldn't I get into the stock? No, absolutely not, because we know the weekly and the monthly is weak. Now, if you just look at the daily, obviously you'd say I'd get in, but that's why you look at those time frames. All right, hope that helps. Okay, let's look at this one. Interested in your guidelines on how to select candidates for selling cash secured puts. Okay, typically any option trades, I'll just give you my basic insight on just options in general. You probably want to trade, normally you want to trade options when the volatility is higher. That's why I always talk about higher VIX. Higher VIX is better. Sell-offs are good for the market for option traders. So even selling cash secured puts or selling puts, selling calls, anything really, anything option related, what you want to do is go ahead and look for stocks usually above $50, $70 is what you want to look for, like things like SHOP and very nice option open interest. If you don't have the open interest, it's a little bit, iffy to trade. Look at CMG. It doesn't have a lot of open interest. Actually, it does nowadays. I haven't traded the options on it for a while. Didn't used to. Priceline, I know, doesn't. But now with a lower dollar value, it does. You can see open interest is pretty good. But you can see Priceline here. It's, 20 contracts, 10 contracts, 30 contracts. Makes it a little bit tougher because the bid-ask spread, you look at this, bid-ask spread is around $3 difference. So almost 4. So that's a little bit tougher. CMG is a little tighter. So you could see here, it's only about 80 cents difference or even 40-cent difference on the bid-ask spread. So that's a little bit better. Again, anything over 50 with a little bit higher volatility is good. So things like Microsoft may be okay because it's 84. But the other issue is the volatility here. You can see it's 16 or so. It's a little light, so the premium there is not really fantastic. So that's kind of the other issues. Even with higher stocks, if they're not that volatile, the premium there is minimal. Can you do it? Yeah, but you need to leverage up with more contracts and some other strategies. Anyway, hope that makes sense. Just overall option choosing of which ones to trade. When I trade in small quantity, I'm always right. And when I trade big, I always fail. How to fix this? Well, how small is small and how big is big? How about medium size? So if you're trading small is 5 and then you're trading big is 50, well, you might want to start somewhere in the middle or in between. Take it in stages, be consistent. And, if you're talking about option contracts, if you're doing 5, then go to 6. From 6, go to 7. It's normally with your account. The great thing about having a real account is it allows you to grow personally as fast as your account grows. So it's kind of like if, let's say, you start at $10,000, well, as you make money, and let's say you're trading 50 shares, well, as you make more money and that account grows, maybe now you can trade 55 of the same stock. Then you might be able to trade 57 shares of the same stock and 59. So it allows you to grow incrementally. But if you're going from, 5 shares and then 50 shares or 500 shares, that's a big leap. Anytime you jump from one hurdle to the next, think of it like weightlifting. If you're lifting up, 5 or 10 pounds and you're doing your exercise, whatever the exercise is, and you go to 100 pounds, it doesn't work that way. It never works out well. So you always do it in stages, and you got to grow yourself personally. A lot of it is due to emotional psychology that you psych yourself out. The risk that you have, you're not in your flow. Here's a little flow channel for you again. And then if you draw this out, some of you've probably seen this in my trader transformation course. If we have kind of skill versus your difficulty of the task right there, if it's too difficult and you have low skill, obviously, you know, you're going to have anxiety. If it's the difficulty is low and you have a ton of skill, it's going to be too easy and you're going to be bored. So that's why you have the flow channel here, right there. That's where you want to stay. Match the difficulty with your skill. Okay, let's see if I can answer this one. I have $500, I would imagine, and have learned options for the last year. Just started real trading a few months ago, and I'm down 380. I'm doing 30-day long calls with 50 delta and usually close out a few days later with small profits. Any suggestion for better performance? What would you do? Yeah, most people that are profitable trading options do not buy options. They're usually selling options. You buy options to hedge your positions. You know, I'll buy options on an iron condor. It's a, you know, in certain situations. Let's see if I can put a quick, actually, let's do Tesla. It's maybe easier. I'll buy an option to hedge something, sell, but you're normally selling. So if we sell an iron condor, and just slap this on real quick. Let's do the calls at 300. Let's see here. I could do it fairly quickly. Do 200 and 220 and 310. Okay. All right. So let's say I have this contract. Actually, I go a little wider. Let's say 360, 340. Okay, so let's say I have this iron condor on. Will I hedge sometimes if things are going against me? Yeah, you can hedge by buying a contract, but normally I'll go, like, let's say to the 72 range. I might buy a single. Let's say it's moving a little against me, right? So it may make the graph look a little funky. And let's go to the 360. But what it does is it transforms my iron condor and it hedges it like that. So that way, if the stock continued to head higher, I could just hedge it for a few days like this. And that's the way you would do it as far as buying things. Normally, when you're doing 30-day long calls, 50 delta, I mean, you know, you want to go wider, and that's why most people lose money on options, because they're buying options. And again, as I mentioned earlier, it's set up to make it difficult with the level 1 option requirement. You can only buy. So anyway, that's the time I buy it. But yeah, you can't do an iron condor spread without at least margin of 2,000. Yeah. So I mean, exactly. So I'm just sharing with you the reason I would be buying an option. Most of the time, I mean, if you have $500 and you're trading options, you're better to take that $500, invest it in yourself personally, books, whatever, and build that account up rather than, you know, blowing it on options. Because when you do that, you're taking guesses at which ones are going to explode, and they need to explode quicker because you have the theta decay. Anytime you're buying an option contract like this one, you know, and you look at this right here, you have an option call, and right here you have a theta decay of $10 every day. So of course you'll be losing that money in premium. So that's kind of the main struggle for most people. I'm still not sure how to develop my strategy. Is there a set of questions I should look to answer, ponder? Thank you. It comes down to your personal risk style and strategy. I mean, it's tough to figure it out. Sometimes you might want to, you know, follow a few different people to get some ideas and experiment with things. It comes down to looking in the mirror. Really, that's the end thing, is when you look in the mirror, are honest with yourself, that's really where things will click and come together. But it takes a long time, and some people never get it because they're always looking for someone else's strategy. My goal, my point and purpose really is to share with you different insights so that you can find your own strategy, because the way I trade may not work for you or somebody else and so forth. But what you might be able to take is a small little piece of that and use it for your benefit to continue to explore other opportunities to create your own strategy around that. So it really comes down to you know, discovering things for yourself, just like what exercises will work for you. What type of foods do you like? As you know, a baby grows up, you need to discover those things. And the same thing here, you need to play with different things, and trading lightly can help do that. All right, what's your take on algo trading over live market action? Are you referring to algorithmic, that you place your money into algorithms, or algorithms just trading in the live market? As far as algorithmic trading to invest into these machines or robotic investors, I mean, for me, I don't really care too much for them because they just do things automatically. For many people, it works out great because they don't have to think much about it, and it's fine. You know, if that's the way you want to trade, invest, there's nothing wrong with that. It's just a different approach. As far as just the general movement of the markets, the way they've been moving, I don't usually like it. I don't like computer trading because it reduces the volatility, and most of the movements these days, at least probably 30-40% of it, is all computer based. So again, it slows down the trading, and it makes it actually more difficult to trade. So you're a little less active with lower volatility, because that's what they do. They buy things up, or they sell things at higher prices. There's a lot of things that happen like that. So anyways, I hope that answers the question. Okay, big loss, ignorance, small profit, importance. What matters first? I don't think I understand the question. Big loss, ignorance, small profits, profit, importance. I mean, I'm not exactly sure what the question is. If you could rephrase that, that'd be great. Hi, Sasha. I completed your introduction course. I'm trading on the Robinhood app, a couple of stocks, but I don't know how to read charts as to when to get in and out. Do you have any advice or direction for me? Yeah, you could study technical analysis. Robinhood is not usually a great charting platform or really an app. I talked about this in the last webinar, that they usually route things through their partner platforms or partner brokers. Anyway, if you're looking for learning how to read charts, you could pick up a book on technical analysis and kind of start there, or look at the getting started page that I mentioned earlier. Right here, bring you right back to this and start right here. And you could even go to, let's say here, technical analysis basics. You could start right here and go to that, and that'll give you a lot of education as far as that goes. So look at all these videos. If you really want it in sections, there's a training section up here, and that'll point you kind of to the same area for technical analysis basics. And I think that's the main one right here. And then you get a full list of all those videos, and there's quite a handful of them. So by all means, enjoy, and they're all free. Hope that helps. You seem to use several timeframes in your chart analysis, like 6-month daily and 1-month daily. How do you decide which one to use for each stock? I mentioned this one earlier question. I always check the monthly, the weekly, and the daily. You want them all working together. So it's not, you don't just pick one time frame for one stock. You look at all of them. You look at all things and put them all together. It's not just, you know, you don't just look at one thing. You want to see the whole picture, right? So that's how you decide. Since 2013, we have never seen any major correction. How to judge when it will come? You really don't know. You don't know when that correction will come. Oftentimes what I look for is anytime you have a huge explosive moves to the upside for a long extended period of time, and what is long really just depends on the past. That's when you be careful. When everybody's really happy, when you're cheery, when your neighbor is getting into the market, when you hear people at the gym talking about stocks, when you hear it on regular radio, that's usually the time I'm very cautious. Because as you look at things that, we'll just use, you could even do the composite Market's usually led by the composite. As you look at it, yeah, I mean, things are quite stretched, but can this be an A to B to D pattern? Yeah, absolutely. So these things, they like to pump these things up. And if we start looking at these things, man, I mean, they are stretched and I don't like it, but that's the market we have. That's the game that's being played. And when you look at it here, I mean, look at the overall average should kind of be going at this angle, but now we're steepening on that angle, and that can happen for a while, as you can see, for a handful of years. But on the bigger perspective, you're going to get a nasty drop. But will it come in another 5 years, 10 years? You don't know, but it could come down to 1,500 where you get a massive sell-off. And if not there, let's say we reach, let's say we look at 3,500. Let's say we get to this level, then it drops down to 2,000. That's still a pretty significant drop. So you never really know, but the further it stretches, the more careful I always get. You know, every time people are happy, I'm always more cautious. And every time people are, you know, selling and dumping shares, that's when I'm looking, hey, let me nibble a little bit, a few shares. I usually do a lot of things opposite of what the market or other people do. So that's just my take. Okay, so usually you like to see open interest in the hundreds or more. Yeah, when you're talking about options, definitely, and depending on the size that you're trading. I like to trade, yeah, very highly liquid things just because it's good for my account and the size that I trade. But, you know, if you're trading one or two contracts, it's usually not an issue to trade lighter open interest, but the issue is you have that bid-ask spread. That's the problem. So that's kind of a problem because you lose out some money as far as favorability goes. So anyway, higher open interest is always good. So I would definitely always look for more open interest when possible. Okay, and last question. Hello, Sasha. I understand the stock market, but my biggest issue is picking stocks. I make a list of the potential trades nightly and seem to decide to trade the wrong ones. The ones I don't choose seem to be the ones that run. What is your process in deciding which stocks to trade? Typically, I have my list of favorites, like let's say right here, and there's not a huge amount of them. Let me move this over for you. It's only 179, and typically I will trade the same stocks over and over again. So most of these I haven't touched. I probably touched the main ones I've touched would be things that I've posted in the critical charts, like the Amazons, like the Apples, the Facebooks, the Netflixes. I've touched those. You know, I've touched a handful of other things for shorter term trades, AMDs. Let's see, Caterpillar for a while back. Now I think it's a little stretched. You know, you'll typically trade the same stocks over and over again, kind of like going to a restaurant. You know, when you go to a restaurant, is it going to be a brand new restaurant every single time you go out? You've probably been to the same restaurant a couple of times and you have kind of your favorites or places you pick up and that kind of thing. So the same thing in stocks. You'll probably have your favorites and the ones you like trading because you know them. You know how they behave, react, move, and those are the ones you'll probably want to stick with. If they're not moving, if the chart's not set up, be patient, allow them to set up, and then do those. Don't force yourself to trade a stock just because you're trying to push yourself to trade that day or, you know, deciding to trade that day. So really keep it simple. I would say a list of 20, 30, 40 stocks, and then maybe narrow it down to 10. So it's kind of the 80-20 principle. You take your 100 stocks, narrow that down to do it reverse to 20 stocks. Then you take that 20, again, do the 20% of that, maybe 4 stocks. So you keep shrinking and shrinking, going from, you know, 80-20 to this one. Then zoom in on that and then go even smaller. Then zoom in on that and go even smaller. So you just continue to reduce, and then you're really only looking at 3 to 4 stocks, and then you decide, you know, that day or that week, but you know, make a plan and then go for it. So that's kind of the process simplified. But usually I trade the same ones over and over again, and you get familiar with them. Just like your best friend, your mother, your father, you get familiar with them and what they're going to do if you burn the carpet down, or what they're going to do if you spill milk on the floor. You get familiar with them and their behavior. And the same with stocks. It's just you learn, and it makes it easier to predict the outcome. Did you personally trade more stocks or options? At the moment, especially in these market conditions, definitely more options, just the way that we've been trading with the grinding. Definitely more options right now. I would say, yeah, for sure, more options. Stocks are fine. I'm just too concerned with where we are in the market, and I find options can reduce that much more so. And also, as you look at options and you get more advanced, again, this is level 4 option strategy, you can do synthetic trades, which if you don't know what a synthetic trade is, I think I might have shared it before. I try not to share too many advanced strategies with people on YouTube or open area, not because I don't think you can handle it, but sometimes it'll do you a disservice, and it'll scare people. So, I try to make things the level that you're at. When we do coaching sessions, I do get into these things, but here's a synthetic for you that starts out with a call. And then we go ahead and we buy a single over here on a put. Not that one. There we go. Sell a put. So now you can see, if you know and understand stocks, and you go and you buy a stock, and you buy 100 shares of stock, you have your delta of 100, right? And this is buying a stock, and it requires much more capital, right? So when you look at a stock, the capital that's required to put on this trade is, well, quite a bit more than if I was to go ahead and buy a call at 305, and then I sell the same thing on the put side, and it gives me still a delta of that 100 with a time decay of only about $1. It's not really much. So even if you move up and down, it gives you a exposure of a stock, same exact graph basically, as you would just in options. So you can do quite a bit with options if you know what you're doing. Maybe that blows your mind, maybe it doesn't, but you need to have the appropriate risk levels in your account to be able to do that. With a stock, it's easier to get in and out, and you don't have to account for the volatility that you do with options. So there's always pros and cons with each. But at the moment, just based on market conditions, I do prefer options the way they are. But anyway, doing synthetics like this, you can make it look exactly like a stock, or just about very close, as you can see. So I hope that kind of opens up your mind a little bit of how serious and in depth you can really get into these things. Do you think it's best to trade stocks over $5? Yeah, absolutely. Typically stocks, anything under $10, $12, they're cheap, and they're cheap for a reason. Just like you go to buy toilet paper, you go to buy something that's cheap, that's, normally costs $100, but you might be able to get it for $35. It's cheaper because it's cheaper for a reason. You either sacrifice quality, you sacrifice service, you could sacrifice salesmanship, delivery could be bad. So yeah, there's a reason that stocks are cheap. And sometimes you can find good value, but don't think you're the smartest ones to find, hey, this is the next great thing that's going to explode to the upside. People do that because they think they don't have a lot of capital, but remember, it's about the percentage of gain on the stock rather than the amount of shares you can buy, and then, hoping to get, $1 gain on a $5 stock. Yeah, sometimes that happens and you luck out. But most of the stocks that are $5 are not trading $1 or $2 a day. They're trading, a couple of pennies a day or a few cents. Okay. Convergence and divergence. Okay. Sasha, can you explain convergence and divergence and how to recognize it? Okay. What are you referring to? Technical analysis for an indicator when you're referring to this? What specifically do you mean? In the meantime, let me go ahead and go to the next question. Would you recommend covered calls for a beginner? If so, what is the downside, as it sounds easy to do? Definitely, I would recommend covered calls for a beginner. because it's a good starting point for options. So let's say you have your stock of Tesla and you sell 100 shares at 335. Okay, the biggest downside is, well, when you have a stock and you get the assignment, let's say the stock moves past it, right? So you have a stock, there's your stock, then you have your single call, which looks like this, and then you combine it, it caps your profits. Well, the issue is if that stock actually breaks past that 335, if it's 335 and 1 penny, well, you lose your stock, and then you just get back in it and you keep doing that process. The downside is, well, you lose your stock and you pay maybe a exercising fee of $30 or $50 or no dollars, depending on your brokerage account or what rates you have. And then you get back into the stock and you keep doing the process. So that's really the downside. You still get to keep your premium though. So you still make your $965. But of course you're putting up a lot of capital for the 100 shares of Tesla. So that's the downside. Other than that, there's no real major downside. You have to covered calls, you're doing it with stocks and options combined. If you had 300 shares, you could just do 2 shares to sell the covered calls. So that kind of changes your graph and it allows you to keep an extra 100 shares. So you don't really have to sell 3 contracts if you have 300 shares. You could just do 2, or you could even do 1. So then only 100 of those shares are gone if it moves against you. Hope that makes sense. Do you use news when deciding to trade a stock? I hear a lot about Benzinga as a source for stock trading news. Yeah, I actually did a review on the Benzinga platform. It's a decent platform for news. I don't use news at all, to be honest with you. I don't read any news thing. I don't read really any articles as far as news goes. I don't watch TV for stock trading picks. I do have financial channels on to see headlines, just to see if there's something sudden that happened or an alert. That's probably the only thing I really use it for, and I'll glance things over because I have another whole computer set up with another 6 monitors over here to my other side. So I'll just quickly glance over and see if things are, what's going on. Is there some issue? Because they'll report on it very quickly. But otherwise, I don't really look at the news, read the news. I don't really watch anything like that. And even earnings reports, nowadays I don't even listen to them because I'm not in the earnings when those earnings reports come out. Usually I'm getting into them after the earnings if it's a stock, which nowadays I'm trading more options and sometimes more indexes as well, because just with the market the way it is. But the point is I'm looking at the movement of the stock, not necessarily what the news is. The news is just there for entertainment. They always have a bull and a bear, and they have kind of that thing to attract viewership. It's not always useful for investing, and it clouds my judgment personally, which is what I found over the years. So anyway, let's see. All right, last question. I just signed up for your critical chart service. Where should I start with using your videos to enhance my trading skills? Start with the Start Here section. Go back. I would recommend you watch all the videos there in the critical charts if you're on the videos areas, or just look through charts. It's great to just look at the critical charts to just go ahead and learn some technical analysis skills. And, not every chart is going to hit perfect and it's not always going to work out, but it just gives you some train of thought to see a different perspective. And your opinion might be different about certain charts, and that's perfectly okay. I'm sharing you my insight. If you have a different way to analyze things and it works for you, there's nothing wrong with that. So, start putting those things together, multiple forms, multiple factors, and start thinking about it, and either get a buddy or a friend to kind of piggyback off of you and make you think about those things to say, hey, you're wrong here, or start second guessing yourself so that way you can evolve yourself to that next stage. So that's how I would do it. Okay, last one. To follow up, 30 days covered call. If the stock goes down and you can't sell it, what do you do? Okay, to follow up on a 30 days covered call, if the stock goes down and you can't sell it, what do you do? I'm not sure what you mean here. To follow up on a 30 days covered call, if the stock goes down and you can't sell it. Well, if the stock goes down, you could still sell a covered call. It's just, you know, let's just take this one. I could still sell a covered call on this if the stock is going down. It's just that I'm losing more on my stock than I am getting from the option side. So let's say this goes down to 250, right? My loss at 250 right here would be, not that one, but right here, 13,764. I look at this number because that's at expiration, not this number, right? So I'm looking at 13,000. That's with the call, right? So 13,000. Without it, I'm over here at 16,000. So you could still sell a covered call if the stock is going down. It's just you're losing more on your stock value than you are making on the option side. All right, I hope that's helpful. We did a lot of questions. Thanks for bearing with me while I take care of my sinuses and things like that. So I appreciate it. I hope you guys enjoy the rest of the week ahead. This video will be posted on the YouTube tomorrow, and we'll make sure that it's out there again on high definition. So if you want to look at some things in detail, review some questions. And other than that, you know, we're coming into Christmas season. Usually that's a really good time for trading. Markets usually like to go up. There's a lot of enthusiasm there, but always be careful as things continue to stretch. Otherwise, thank you for joining me. If you've missed this webinar and you're watching the replay, be sure to sign up on the newsletter list, probably somewhere on screen. Get notified when the next one is. I try to do one every month at the beginning, either the first or second week, and you know, answer as many questions as I can. So thanks again. Enjoy your weekend, and I'll see you next time. All right, take care. Bye.